When the rupee weakens, the impact is not limited to the dollar exchange rate. It can affect petrol, diesel, food prices, imported goods, foreign education, travel, and inflation. That is why the Reserve Bank of India has recently taken steps aimed at bringing more foreign money into India, reducing pressure on the dollar side and keeping the rupee more stable. But the real question is, can the RBI actually strengthen the rupee, or are these measures only temporary relief? In the June 2026 monetary policy meeting, the RBI kept the repo rate unchanged at 5.25%, so interest rates did not change. But the bigger story was not the repo rate. The bigger story was the RBI's foreign capital and rupee support measures. The direct aim of these measures is to increase dollar inflows into India, because when more dollars enter the country, pressure on the rupee can reduce. And if foreign investors find it easier to invest in Indian bonds, deposits, and markets, capital inflows can improve. Now let's understand what the RBI actually did. First, the RBI made it easier for foreign investors to access some long-term government securities. Reports say 15-year, 30-year, and 40-year government securities were included under the fully accessible route. This means foreign investors may get better access to Indian government bonds. Second, investment operations were made easier for non-resident investors, including NRIs and OCIs. Designated repatriable rupee accounts can help them manage investment sale proceeds more smoothly. Third, FCNRB and NRE deposits were made more attractive. The RBI temporarily removed rate caps so banks can attract more deposits from overseas Indians. Fourth, export-related easing. Bringing the export realization period back to 9 months can give exporters more operational flexibility. Overall, the RBI's message is clear. India wants stronger foreign inflows, and the RBI is taking rupee stability seriously. Now the question is, how can this help the rupee? The strength of the rupee depends on demand and supply. If more dollars come into India, if foreign investors buy bonds, if NRI deposits increase, or if export payments flow in, dollar supply can rise. When dollar supply rises, pressure on the rupee can ease. If these inflows remain strong, the rupee may get support. Pressure on forex reserves may reduce, and import costs may become easier to manage. But this is where balance is important. The RBI can support the rupee, but it cannot keep the rupee artificially strong forever. Many external factors affect the rupee: crude oil prices, U.S. Fed interest rates, global dollar strength, foreign investor sentiment, trade deficit, and geopolitical risk. If crude oil becomes expensive, India has to spend more dollars on imports. That can put pressure on the rupee. If U.S. interest rates stay high, foreign investors may move money away from emerging markets like India and toward dollar assets. And when global risk rises, investors often move toward the safe haven U.S. dollar. So the RBI's measures are helpful, but they are not a magic solution. Now, is a stronger rupee good or bad? A stronger rupee can help ordinary people in many ways. Imported goods may become cheaper. The oil import bill can become easier to manage. Inflation pressure may reduce, and people spending on foreign education or travel may get some relief. But a very strong rupee can create problems for exporters, because Indian goods may look more expensive in global markets. Families receiving remittances from NRIs may also receive fewer rupees for the same amount of foreign currency. That is why the RBI's usual goal is not an extremely strong rupee. The goal is a stable rupee. So the key takeaway is this: the RBI's new directions are an attempt to support the rupee. They may increase foreign inflows, improve investor confidence, and reduce short-term pressure. But the rupee's real direction will not be decided by the RBI alone. Crude oil, the US Fed, global markets, and India's trade balance will also matter. So the headline is not that the rupee will suddenly become very strong. The real headline is, the RBI is activating tools to protect the rupee from sharp weakness and improve confidence. The rupee is not just a currency. It is also a signal of India's global financial strength.